In each show, we share with you real-life lessons from my real estate experience. We invite industry experts, innovators, and influencers to explore the challenges and opportunities facing small multifamily real estate investors. And we've designed this show to answer some of the questions you guys have had around raising private money and making profit first in your business. I've invited a special guest on today's show, James Masotti. You guys are not going to want to miss this. He had an incredible journey in growing a real estate business and now an accounting firm. I will share with you his bio in just 1 second. However, if you like these types of resources, this show, you want to get more information, there's 2 things you can do. Number 1, subscribe to the YouTube channel. That's the best way to stay updated with the content. The second thing you can do is head on over to www.nathanbushmba.com/subscribe. When you subscribe, I'll send you some free resources that will significantly help you, some ebooks, some case studies, things like that as you grow on your real estate journey. Check out the other resources in the links in the show description. All right. Today's guest, I want you to think about an episode movie, actually. Do you remember the movie Avengers when Tony Stark in the movie Endgames, he sat down and he said, "Oh my gosh, I figured it out." Well, today's guest, James Msadi, figured out private money, and he really is the Tony Stark when it comes to real estate. This guy's a genius. You're going to want to understand that success in real estate starts with the right mindset. It starts with the right mindset about money. It starts with the right mindset about private funding. And if you really want to begin in real estate, you didn't have any money, let's listen to James Msadi. What you're going to hear today is from a seasoned real estate investor and entrepreneur who began his journey as an accidental landlord in 2008 with a background in supply chain management. He actually logistically then decided to acquire over 17 properties in Wilmington, Delaware, using his own money. He co-founded Crystal Clear Property Management, and then he went on to acquire an accounting firm in 2023. As a profit professional, he is dedicated to helping businesses overcome cash flow challenges and achieve long-term success. Outside of work, I know James loves to spend time with his family, and he's true to his core values of continuous learning and personal growth. I'd like to welcome to the show today, James Msadi. What's up, James?
Hey, Nathan, how's it going? Tony Stark, huh? I don't know. Those feel like some pretty big boots to have to fill.
Yeah, but I was really thinking about it prior to today's show, and I was, you and I had a previous conversation, which really helped align why I wanted to bring you on and introduce you to the audience here, because, man, you have an entire background in private money. You raised money. You bought 17 properties with not using your own money, learning how to use other people's money. And there are so many people that want to get into real estate, but they don't know how to do this. Mm-hmm. What even got your drive? Take us back. How did you even become interested in real estate, James?
Yeah. So my initial interest in real estate was, honestly, I bought my first primary residence in 2008, right when, the market completely crashed and fell out. The house that I bought was in Wilmington, Delaware. I lived in Southeast Pennsylvania, right outside of Philadelphia at the time. And so Wilmington was nearby, and this house came up on the market, and it was just stupid cheap. And literally, like, identical house on the block had sold, in February or March of that same year for like $165,000. And then I bought my house for, I can't remember, it was 60 or 80,000, something like that. Right. So again, this is right when everything kind of collapsed. So did that. And then my company relocated me to California. And so I put a renter in place, and I ended up having that renter for 10 years. So started off as, like a lot of people, I think, as just an accidental landlord. And then after kind of going through, my career a little ways, I got to Amazon, and one of my Amazon coworkers that came in on board from UPS had invested in a bunch of property in Philly, and we just had started getting to talking. And I was like, you know what, maybe I should start looking at, being more active in acquiring real estate, because this one property I had been a great experience. And so that was, is that like 8 years ago or something like that, I think now, that I kind of started to actively want to dive in and start buying properties.
Oh my goodness. So, there's so much to unpack with that, James. First and foremost, there's a lot of investors that are struggling right now with traditional financing, trying to get traditional financing. Interest rates have creeped up. What's your whole thoughts and take, before we even get into the private money conversation, on the market and the way things have shifted for people?
Yeah, I definitely think that it's made things more difficult, right? I mean, in full transparency, since COVID, I've only bought one property. It took us buying a little different than what we bought, call it pre-COVID, but it was a house that was one door down from another property we own. So we've got a few, the way our properties are laid out, we've got a few properties like all on the same street, and we really like kind of having that control. So when this opportunity came up, we decided to jump at it. But it's definitely not, what I call like it was back in the day. So many people who you see these run ups, and I had the fortune of benefiting somewhat from that. And I think it's just you got to really give it some thought in terms of what your goals are, that you're trying to accomplish, because the biggest thing is there were a period of time, and there's a lot of gurus out there that'll talk about real estate being anybody who's worth the pound of salt will tell you real estate is not a get rich quick scheme for the vast majority of people. However, there are people out there who did manage to acquire very large sums of properties in a very short amount of time through a lot of different avenues. And I think that's become a lot more difficult to do, given kind of price inflation, rent changes, the regulatory environment, and of course, currently the rates on financing and stuff along those lines. So,
yeah. So, the private money is something that we're definitely going to talk about.
Yeah.
But the market shifting is a major concern for a lot of people.
Mm-hmm.
In addition to the market shifting, I'm sure that there were a number of different concerns that you had whenever you first started in business with management. I mean, you've got a logistics and operations background, and you started a management company in order to be able to take care of those 17 properties. What were some of the major concerns that you had with other people managing your properties for you?
Yeah, I mean, realistically, what I saw is the property management companies that we had previously used, and we had gone through we had gone through two, and we were getting ready to start a third property management company, And at the time, my general contractor, who is a partner in my property management business now, he's also an investor, owns a bunch of properties. And part of his business was that he also did maintenance work for a lot of property managers. And through his conversation, he was like, I've been doing this for a couple decades. You're not going to find anybody doing things any different than what you're already experiencing with the people that, you've used. And so that was like that, just was mind boggling to me. Right. And so it was a combination of my business partner, in all my real estate holdings and stuff along those lines, has been one of my best friends since grade school, was my original private lender. And then, all of that sort of stuff. When he was doing his MBA, he actually did in his entrepreneur classic, his project was on property management. And so between my operations background, kind of his experience from his MBA, and then having, again, our other partner to kind of handle all the maintenance stuff, the three of us were basically just like, you know what, if we keep on banging our heads against the wall trying to do this, go to these other people and we feel like they're not doing it, why don't we just do it ourselves? We'll make sure the maintenance is getting done, to the level and standard that we want it to be in, provide people quality homes to live in, really the focus on property management. And luckily in Delaware, you can manage properties for other folks through a power of attorney. Legally, you don't have to be a licensed agent or have a broker involved. So because Delaware is set up that way, we can manage our own properties, and then we can just set up basically a power of attorney with our clients that allows us to manage properties on their behalf. And so because of that, we were basically able to say, look, this doesn't require a real estate license. This is all about operations and about again, processes and procedures. And that's what my background from a supply chain perspective was. And so, we just really kind of set out to start with our own stuff and then, figure out building something that we could offer to, the rest of the market.
Yeah. And so, we talked about finding financing is a little difficult right now. We talked about the issues that people have with property managers. And then the last issue that people are going to have before we even get into this private money is understanding the market. Mm-hmm. Like you said, he found this house for $60,000, was off market. And you got to have intimate knowledge of the market. You can't just go on the MLS and expect to be able to buy and start your career in real estate and actually be profitable, at least in my experience and opinion. How about yours? How do people begin to understand this market before they even get into it?
Yeah. I mean, it may sound really silly, but a lot of what I learned about real estate, I was from the website Bigger Pockets, right? And listening to their podcasts and all that kind of stuff. And Brandon Turner, back when he was with Bigger Pockets, I mean, he talked a lot about, if you're just trying to get started, just go out there and analyze deals. Go on the MLS, right? And in the areas that you're interested in looking at, and run the numbers on what it's going to take to buy those properties on the MLS. And what you're very quickly going to learn when you do that is none of those deals generally are going to pencil out, right? And so you're going to be sitting there crunching numbers going like, man, how do people buy these things? The numbers don't work. The math doesn't work. And the answer is they either don't, or they have a different investment philosophy. There are plenty of investors out there. I've met them. Their goal is to buy one property a year. They're going to use their W-2 earnings to put a 20% down payment through conventional financing, the Fannie Mae, Freddie, buy 4, buy 10, whatever it is you're allowed to do, under your personal name kind of stuff, right? And they're okay with that kind of just like, hey, I'm going to buy one a year, and in 20, 30 years, I'm going to have a great portfolio. And they're willing to, as part of their investment diversifications, go that route, right? But if you're somebody who you want to have your cash, recycling more regularly, and you want to have different, you have a different risk profile, I guess would maybe be the way to say it, you're going to realize those deals don't pencil out. So then what you're going to do is start just naturally being like, okay, well, like if I were to buy this house, I'd have to pay this much for it. If I were to buy this house, I'd have to pay this much for it. And you're going to start kind of figuring those things out so that when you start going to those real estate investor meetups, or listening to podcasts, or connecting with wholesalers, or whatever it might be, through those relationships that you build, or you do your own direct mail or whatever outreach to buy properties, you're going to know what numbers you need to hit. And then when one comes around where the numbers make sense, you're just going to know, because you've already done enough analysis on deals that don't work to be like, wait a minute, this one might actually pencil out. Let me go take a deeper dive. And that's really what I did. I looked at a lot of deals that weren't going to work. And as soon as I saw one where the numbers made sense, I was like, that's going to be the deal.
Yeah, absolutely. Guys, we're talking with James Msadi. He is a real estate investor, an entrepreneur. This guy is really incredible. And I got to dive into his information about private money. So just hang in there with me. But if you're new to the YouTube channel, make sure you hit the subscribe button and smash the bell. That will get you notifications of whenever the show comes up. In addition to that, I want you to head on over to www.nathanbushmba.com/subscribe. Those two ways will get you notifications, and you won't miss out on anything ever of any of the information that I'm sharing with you. And don't forget, this show doesn't happen without our sponsor. Our sponsor is Red Maples. We show small multifamily real estate investors how they can achieve double-digit returns with institutional-style property manager. You can scan that QR code or go to red-maples.com/assessment and get a free assessment of your rental portfolio. Most of the time, investors don't understand the money. They don't understand how to actually utilize and leverage the equity that they have in their portfolio. We show you how to do that. We're not for the novice real estate investor. If you have 1, 2, or 3 houses, you know what? This probably should be self-managed, and you can learn to do that on your own. Or you can try a different management company and learn about how bad they actually are. I talk about that over and over and over again on the show. I want you to head over to red-maples.com and hit /assessment. If you have, 10, 15, 20 properties, and you're looking for a professional institutional style manager that looks at the asset as a whole. So scan the QR code, go check us out, red-maples.com/assessment. Now we're back with James. James, real estate investors often hit a growth ceiling due to the lack of access of flexible financing options and insufficient management strategies. That's what I wanted to touch on leading into this conversation. You seem to be able to navigate this finance deal and put together private money to borrow on your first couple of properties. I know you did your first flip, you said, and then you're able to go on and get into private money. How did you get introduced to? I heard that he was he was an employee maybe with you or worked with you. How did you get introduced to your private money lender? First of all, how'd you guys meet?
Yeah. So my very first private money lender, like I said, was my best friend. And he's now my business partner. So again, I've known him forever. I knew what his job, was roughly kind of what he made. And, I think, he didn't have any student loan debt. So I was just like doing the math in my head going like, I know this guy's frugal. I know how much money he makes. He's got to have some cash laying around. And so I called him up and I was like, hey, I've got this deal. Do you happen to have any money that you'd be willing to invest? And he was like, yeah, sure. How much do you need? And again, that particular deal, again, I can't remember the exact numbers. I probably should have looked it up before I jumped on, but I want to say I bought it for 35,000 maybe. And so that's what I asked him for. And then I basically decided to fund the rehab myself just because and I didn't want to overextend. It was the first time and things along those lines. And I mean, we can get into the nightmare that deal ended up being, but
let me ask this question. Did you have the deal under contract first, or did you come to him with a deal that you found?
That's a really good question. I don't know which way it went, to be completely honest. It was quite a few years ago now. But if it wasn't under contract, I basically looked at it that day and called him up and was like, hey, let me run through the details on this. What else would you want to know? Because I want to go put it under contract. So I can't tell you which one came first, though.
Was it off market?
So it was that particular deal back. I don't honestly know if it still exists, but Bigger Pockets had a thing called the Marketplace. And it was actually it was with a realtor, but it was a pocket listing that she had for a friend, basically, that she posted up on the Bigger Pockets Marketplace. And that's where I found it.
Yeah, so I don't know whether Bigger Pockets has that or not, but if you're looking in St. Louis, there are literally hundreds of different online communities that people do this all the time, guys. In addition to that, if you're not part of the different local meetup groups here in St. Louis, even if you're from out of town, come join these different meetup groups from time to time, get on their list, because people then will send you deals that are off market. So I know in St. Louis, there's Tours and Pours, which I'm hosting on June 26th. We got a special guest and a tour. We're going to be touring and going back to a local restaurant in St. Louis. There's also a group out here called St. Charles County Real Estate Investors Association. I just spoke at the Voiles meetup group last night. There's River City Roundtable. There's a number of these different meetup groups that you can join and get involved with these communities. You don't even need to be from the area. Just come into the area. Let me introduce you to some of these people and some of these different meetup groups throughout the weeks. And if you're coming, send me an email. I'll be happy to share back with you when those meetup groups are so we can connect. All right, back to James. James, so we were talking about your first deal. This deal you said was off market. You found through a Bigger Pockets style Facebook group, online group, chat deal, whatever. And then so somebody shared it with you. It was a pocket listing from a realtor. You had a gentleman that was going to put the cash into the deal for you, $35,000. You were going to do your own rehab. How much money did you set aside in order to be able to do that rehab?
So
roughly. It doesn't need to be exact. Nobody's going to hold you accountable to the number, but roughly.
Yeah. So the number that they had, that the person advertising it, I think they had a number of 12.5 for the rehab. And I ended up, after looking at the property, I came up, my number was something like 18.5 or 19 or something along those lines. So I thought it needed a little more work than what they had identified. And then I had some of that cash laying around, but I think a good chunk of it, I remember I went out and I got myself, again, I had set up my LLC or whatever. So I was able to go get a Chase, business credit card that had a 0% interest for the first 12 months. And I basically told the contractor, hey, I'm going to buy all the materials for this thing so that I can, at least put it on there, delay the financing. And so I think it was kind of a combination of planning to use the credit card and do that, knowing that once I got to the other end of the burr, basically, when I refinanced it out, then I'd be able to pay that credit card off and not have, any of that debt left over. Fast forward to the project being done, and it ended up being closer to, I can't remember the exact number, but $40,000, $50,000 or $60,000 is what the rehab ended up being for a variety of reasons. And so I ended up having to tap into my 401k and took a loan out against that to fund the difference. So
you finished funding it. So how long did it take you to save up the initial funds that you were going to use to do the renovation? Because I'm certain that you didn't think you were going to go out and borrow a whole bunch of money in order to make this happen.
Yeah, exactly. I would say, I had always been, pretty frugal, savings, livings wise and stuff along those lines. So, it had probably been, I had been, out of school working for, probably 5 or 6 years at that point. I'm trying to remember, 3, 4. Yeah. So probably about 6 years I had been out of school saving up, and so I would say, it's just kind of the culmination of, not having tons of money saved up. I mean, I can't remember the exact numbers, but I might have had $20,000 or $30,000 total in savings. So I wasn't about to go put all of that into real estate. But again, when I was like, okay, I'm going to open up the 0 interest credit card, I can run some of the material stuff there. I'll pay the contractor out of pocket, $5,000 or $10,000, kind of a thing like it. And then I knew I had that safety net of, my 401k and, even, if I had to go out and get a private loan or a personal loan or something like that, I had, high 700s credit. So like I knew there would be access to doing things, if I needed emergency cash.
For certain, guys. And this is where I want to jump in and make sure I remind you. This is why I don't believe in no money down. Mm-hmm. Because when it's pitched to you and when people are talking about no money down, what they're talking about is extremely high risk, no mitigation, no responsibility in a transaction. Just go for it. And if the deal falls apart and it fails, to heck with everybody else. I don't care about the finances in this deal. I'm just going to do whatever it takes to make the deal happen. You know what? If that worked for you, I think you're a criminal. Okay. So I don't believe in no money down. You're hearing from a seasoned investor right now who, even though he used private money, had his own funds available for rehab that took him 6 years to save up. I'm not saying it's going to take you 6 years to save up the funds or any of that kind of stuff, but I do want to make sure that I'm making a point to the audience to understand there is no such thing as get rich for free, take and steal from other people and abuse them and get on top. Like, this is a process that requires a intentional effort, and it's just a strategy. James is talking to you about his strategy utilizing private money. In the first deal, $35,000, he was able to borrow from somebody else to put the down payment on the home. He set aside a rehab budget. He had about 20 grand in the bank or so, maybe 10, maybe 18. It's the numbers are relevant. He saved up a certain amount of funds because he knew he was going to do the rehab on it. Then he borrowed some more money in order to be able to finish up the rehab. And then he refinanced out that deal and put that deal on long-term financing. This is not a complicated deal. This was the strategy that he used to acquire that first transaction. Now, he had some learning things along the way, and that's what I'm trying to help you uncover. Because if we can do this in the right way, you can understand some of the downfalls, you can understand some of the benefits that James has done, then you can take his strategy, implement it right away. So, James, when we talk about the renovation being a disaster on this deal and costing you way more money than what you thought, what did you miss?
The back of side of the house was, I'll give you a picture. So this is a row home. So if you picture kind of a rectangular shape, right? 2-story kind of skinny row home. But picture that it only has 3.5 sides. And so basically one of the exterior framing had completely deteriorated due to water damage that was coming through from the neighbor's property. And so the back of the house was basically being held up by 4 layers of drywall. So the reason we didn't know it was because, like, visually there was nothing you could see on the inspection or anything along those lines to give any indication of that damage being done. And it wasn't until we were ripping the floor up and doing some other things that we unfortunately started to uncover some of these things that, whether it was by the previous owner or the person prior to that or whatever it was, but somebody knew about these problems and intentionally covered them up. And so we didn't know about it when we bought it. And we ended up having to literally take the entire back of the house off, reframe it, put new siding on, all that kind of stuff, and then build out the back side of the house. So, I mean, I think that alone added, $15,000 or $20,000 to the rehab budget. And then a few other things that ultimately, showed up that weren't anticipated.
Yeah, those types of things definitely happen, which is why I often preach get a certified inspection prior to buying the home. Maybe they can catch stuff like that. Sometimes they don't. One time we bought a house and the entire basement wall had a faux wall on it because behind the wall, there was a finished basement. Behind that faux wall was a crumbling foundation that was not caught on the inspection, and it wasn't caught by anybody when we were doing it until we saw water leaks in the basement. When we opened up the wall to try to see where the water was coming from, we saw that there was a giant crack in the foundation. The wall was actually buckling inwards. It was about $15,000. So, I'm giving you the red flags. I'm giving you the horror stories. I'm telling you that there are challenges that come up, but guess what? I've done real estate now for over 15 years. James, you've been doing it now for a number of years we're telling stories from 2008. So that's a long time that we've been in real estate. These things happen. And so it's an investment. Now, I want to ask one more, maybe two more questions about this deal. So number one, what was the interest rate and what was the deal structure in this first deal? What did that look like? Was it just do $35,000, I'll pay you back when I refinance? How did that deal look?
Yeah, so I think the way that we structured it was pretty simple. Like, hey, like I'll pay you 10% interest, when I refinance back out. Like it was not money he actively, needed. So we negotiated there was no payments. So basically, as a result of that, the interest just compounded. So I paid him more than 10% when you consider that side of things. But yeah, like I said, it was a relatively straightforward. If I were to go back and dig out the original mortgage, and note or whatever, it was only a few pages long, right, of covering the basic stuff. It's not like when you go to a bank and they put you down in front of a 2-inch stack of papers to have to go through and sign. So,
and James, you're an accounting guy. So like you actually took money out of your 401k to finish up the transaction. There has to have been some thought in the deal or the transaction that if I can make more money in real estate than I did in the stock market, it made sense to put my money into the real estate deal to finish that up.
Yeah. And what I did, so just to make sure it was clear. So when you have a 401k, legally you can take a loan against the 401k for up to $50,000 or 50% of your balance. And it is a loan that is at market rate, and you can pay that back over a period of up to 5 years. And so like when you do that, I was not like taking an early withdrawal and then paying penalties and fees and fines and all of that sort of stuff. But like it was money, I didn't need for the long term because it was tied up in the 401k, and it was more or less at a market rate. Right. And so the nice thing about using the 401k was kind of, again, the way I perceive it, at least, is that I'm paying myself the interest back instead of a bank or somebody else. Right. And so like, if I think the market's only going to do 8%, but I'm paying myself an 8% interest rate, what's kind of the difference? At least I'm benefiting from my own payments. And then the other side is it doesn't actually hit your debt to income or your credit score. So like if you're in a position where your credit's fully utilized or something along those lines, those 401k loans are a nice option just from that perspective too. So like I didn't want to ruin my credit by taking out some big loan. So for me, it was more important to make sure I could still get those good rates on the refinance and maybe pay a little bit extra or maybe sacrifice a little bit of that 401k money. And in terms of what I always put in my 401k, I do firmly, my investment philosophy is I like to invest in myself. I like to have control. So that's why I buy real estate. I buy businesses. I invest directly. I don't necessarily like putting my money into stock market, but when your company has a match, like I'm at least going to put money in, get the match because it's free money. And then whatever investment funds, they're available in that fund is where I figure out what's the lowest cost basis with the longest history of decent returns. And that's where I'm going to park it, so just,
I love it.
Yeah.
No, I love the strategy and the philosophy, and it makes total sense. And I bring it up and bring up the thought process around the stock market because it's so critical to understand, I think, that money operates a certain way, right? So you being a profit first professional, you being an accountant, owning an accounting company, and you probably have learned over time about the way money works. And money works on the returns that you get. It works on leverage. It works on a number of different things that a lot of people are they're overly frightened by. They don't take action on. They won't borrow the money against the 401k in order to do the deal because they're afraid that they're going to mess up or lose it. Mm-hmm. They won't, in some situations, they won't roll the money over into the IRA and then use the IRA as a hard money loan or a private loan to somebody else that's doing real estate effectively or well, because they're afraid of the consequences of that. You can lose money in the stock market too. Mm-hmm. the stock market goes up and it can come down. Both are risks. But you got to, when you're looking at trying to invest, isn't it important to pay attention to what are the risks? What are the potential upsides of the transaction? Because you're looking at people's money all the time, all day, every day, whether it's construction business or real estate business. One of the other principles I've learned is that the cash flow follows assets. So you've got to be acquiring assets. When you're looking at those things, what are some strategies that people can use in order to kind of offset this fear of risk?
Yeah, I mean, I think, different people perceive, fear or risk in different ways, right? So some people are, because I've talked to some folks that, they're like, the risk for me is in, analysis paralysis, right? Or it's in doing too many things, or it's, I'm a high income earner. And so like, I don't want to have to also be doing the due diligence on, individual deals or operators or whatever that kind of stuff is. And so sometimes it's even as simple as, I like the thought and the idea of that, but for me, it's too risky to take my eye off of this other stuff. So I'm going to put my money in the stock market, right? Other people might view it as like, oh, they're always worried about I'm going to get the 2 a.m. call about fixing the toilet, right? You hear that stereotype a lot, kind of a thing, right? And so they don't want to be landlords, but then this whole idea of private lending, private financing is not something that's well spoken about. And to be frank, like there aren't a lot of mainstream resources that teach people about that stuff. And financial literacy isn't something that's taught in school. And that's a whole different kind of debate, whether it should be, that we won't get into. But the fact of the matter is, like, just people don't know what they don't know. They don't understand. So unless you come from an environment where that type of investing, like people don't know that there's secondary market for mortgage notes that you can get into. They don't know that there's private lending. They don't know about syndications. Like this is not stuff that's in the average person's, financial lexicon. What they know about is, oh, you have a 401k, you have an IRA, you put money into an index fund, or you buy individual stocks. And that's what people know and understand. And that's what most people do. And so the general thesis is like, well, if this was really a thing and the returns were great, more people would be talking about it. And so it's kind of that, like, it can't be real, right? I think is what a lot of people is, or if it is real, I just don't understand it, and I don't know where to go to get information about that, because nobody around me does those sort of things that I feel comfortable getting that information, right? So yeah. I think that's a lot of it, is just that lack of knowledge.
Yeah, if it's not the average person that understands those things, then typically who is it?
Yeah, I mean, like it's the people that, for whatever reason. So I'm gonna say, like, it's because they grew up around it, right? Or you accidentally found it, or like I honestly, to this day, like I can't tell you how I found Bigger Pockets back in the day, right? Like I have no clue how I like got to the point where I started accumulating this knowledge. I'm so far down the rabbit hole at this point, but what I can tell you is, like, I did not come from a family with investment properties or with, owning businesses or anything along those lines, right? I came from that very middle class, like you go to work, you're going to work your whole career, you're going to put a little bit of money in a 401k, and hopefully there's enough left over at the end. So what is it that drove me to, I don't want to say break that mold, like it's not a bad thing, it's a great thing for a lot of people, but to go down this path of learning about, all this alternate investment world, or what would be considered alternate compared to what maybe the media would call mainstream investing. And so I think it takes something, whether it's, you stumble upon a podcast or a YouTube channel or an Instagram post or a Facebook. I mean, again, none of that stuff existed. I guess it was starting to exist. Facebook came around when I was in college, so it was starting to come out, right? But like obviously, like the gurus, the way people use information, and gurus can be good and bad. Just people trying to educate the world isn't a bad thing. People trying to take advantage of that and put you into multi-level marketing, like run you up through their courses and all that kind of stuff, is a totally different story. But yeah, I mean, I think it's, the current day and age is making it a lot easier and more accessible for people to learn about this stuff, because it's easy to swipe through TikTok and all of a sudden something catches your eye or whatever, right? So, but yeah, I mean, it's until you find it and it like bites you and you get that curiosity and enough to learn and dig and ask more questions. I think that's the biggest thing. If you've done all of that stuff and then you're still like worried and concerned and like don't want to pull the trigger, to me, you simply haven't gotten to the point where you've built a strong enough relationship with somebody that you know, like, and trust. Like that's one of the biggest things that, like, even people screw up. I mean, look at I mean, it's not real estate, but Sam Friedman, whatever, the guy from the cryptocurrency thing that everything like fell apart and he was embezzling their money or whatever. Like people obviously know, like, and trust him. He had celebrities and stuff like that, like vouching for the business and stuff along those lines. But like, so when you go to try to build a relationship with somebody, like you're always going to have a risk. I think what got me comfortable with it was, one, I was still young enough, right? Like I didn't have kids. It was me and my wife. I was in my 20s. And so there was enough stories about people. It's like, hey, I hit rock bottom. I bounced back. I had enough runway of time that I could come back from something. But it was, you know, you got to take the risk. And one of the cool things about real estate is it's at least a hard asset. Like at the end of the day, like, yeah, I might end up upside down, but at least I had something that I could still like do something with, as opposed to, and if you lend money to somebody and like and you put the proper mortgage and notes in place to protect yourself, like you can take the asset back, whether you know what to do with it or not. When you do that, you at least have an asset you can take back for the money that you put in.
Yeah. So let's talk about that aspect of private lending. So that was kind of the last question, that first deal that I had that we can circle back to.
Yeah.
Is that, so how did that process work with the private lender? So did he give you the $35,000 into your LLC and you go buy the property? Did he buy the property independently and you were on a note for that property? How did that process work? And did it jack up your taxes? Like, talk me through that.
Yeah. So typically, again, I can't remember. I think in that first deal, the flow of money might have been a little unique. So I'll talk how it normally works as opposed to that first one. But again, this was a best friend I had since, second grade. I'm pretty sure he honestly just wired the money into my bank account. And then like I funded the deal out of, not into my LLC's bank account. What we've done since then with private lenders is, we work with a closing attorney in Delaware, whether it's an escrow or a title agency or whatever it is in other states and jurisdictions. You just get the wire information for that person, the closing information, whoever's organizing the document. And then they basically just wire the money into closing on the day of closing. So whether that's no different than a bank would do on a traditional transaction. If you go buy your home, you're sitting there at the closing table, you're waiting for the bank to wire the money in to clear to the seller and all that sort of stuff, right? So it basically works the same way. Instead of coming from a bank, it's coming from somebody's IRA custodian or, again, their personal accounts or wherever the money's coming from. So yeah, I mean, I would say like, does it jack up your taxes? No, because again, at the end of the day, you haven't actually like taken the money, and because it goes in and out, and then at the end, you're going to get your HUD statement and whatnot, and it's going to break down everything. That's what ultimately your tax professional is going to use to actually build out like, hey, where did all this money come from that went in and out of your accounts? And that's how you make sure it doesn't get counted as income and taxed or anything like that.
And that's all done through a title company.
Yeah.
Yeah. Awesome. So that was the first deal, and you've done plenty of deals since then. Mm-hmm. You decided that after doing this first deal, though, that private money was kind of the way that you wanted to grow the initial acquisition and renovation of these properties, correct?
Oh, yeah.
So then walk me through kind of what your thought process was as you started to structure a business around this. Like, mm-hmm. How did you go? I'm sure you brought in other private investors. It wasn't just your buddy that lent you the money the whole time. Yeah. So how did you find that next private lender and have that conversation?
So from there, what I did was I actually built out, wanting to make myself look more legitimate, is I built out, again, I could go dig it up and probably even send a copy of it to you if you've got show notes or whatever you want to put, but I built out an investment prospectus, right? And so it went into, again, my properties are in the city of Wilmington. So I went into like, here's the zip codes that we're targeting acquiring properties in. Here's the demographics of these zip codes. Here's why I like these zip codes. Here's what a property in those zip codes would look like. Here's examples of the deals that we've done and how the things that have gone bad. Because one of the number one things, and exactly where this conversation has gone, right? The number one thing in every single private investor's mind isn't, hey, what happens when the deal goes well? They understand pretty simply, like, hey, if I lend you $100,000 and you're going to pay me 10%, 15% interest, they do that math. They understand the upside. What they want to know is what's going to happen when things go sideways and when things go squirrely, or what's the negative thing and how am I protected? What are you doing to protect me? And the more you can communicate that and ease their fears and their concerns, that's when you're going to be able to get them to lend you the money at whatever rate you negotiate. And so in that investment perspectives, we talked about, we were very transparent on that first deal where, it went completely sideways and we underestimated the budget. But we talked about like, here's what we learned. Here's what we've changed in our process, to do that differently. My third deal, which was one that we did, again, acquired the property, all of that kind of stuff. The property manager we had at the time, I don't know what they were doing, but they couldn't get it rented. And so we had a 12-month note with that private lender. The note came due. They needed the money for another investment that they had going on. We had to pay them off before we had a tenant in place, so we couldn't get long-term financing. So again, you talk about like no money down and having access to your own money. My partner and I had to scrounge together, pulling money together so that we could pay the investor off what we owed him, and then basically either try to secure another investor to take the note on that, or just ride it out until we could put long-term financing onto it, right? So, again, so like being transparent on those, we built out this investment prospectus that we could then shop around to folks and basically say like, hey, here's our thesis, here's what we're doing, here's our track record, let me know what kind of questions you have. And just being able to present stuff like that to somebody, it makes them immediately already start to feel a lot more comfortable, because they can tell you've put in the time, the energy, the thought, you understand the different pieces of things. And that, especially if you have stuff in there where things have gone, I'm not saying they got to go on badly, but where you can show that you've had some adversity through the process. Don't just show them all the great, fantastic stuff, because that's going to show them more about your character than it does about the deal. And that's going to be the biggest deal breaker, is if you can show, hey, when things gone sideways, here's how I communicated that, here's how I dealt with that, and the process I went through, and made sure the investor was communicated with and informed and all of that sort of stuff. That's ultimately what's going to help somebody feel comfortable lending you $20, $50, $100, $200,000 to go do a deal.
Guys, if you're watching online right now, or you're watching on replay and you'd like a copy of that prospectus that James is talking about, put prospectus in the comments so I know, and we'll see if we can get you a copy of that prospectus that James was talking about. I think it might be helpful for a lot of you guys that are looking to raise private money, or if you're a private money person and you want to know, okay, how does a prospectus look? I'd like to know that. Put in the comments the words prospectus, and I'll see if I can get it over to you. All right. James, I got a couple more questions for you about this private money thing, because this is so fascinating. And I know you get an accounting business. I want to get to that information. Before we get to the accounting profit first models and just different things that you're doing, I want to just add a little bit more value to the audience around this whole private money concept. So you put together a prospectus, you started raising capital. What kind of conversations were you having with people to get them? I mean, I'm thinking about this from like a marketing standpoint, right? You have to have a marketing funnel somehow. How are you getting them into your marketing funnel and then setting up an appointment to have a conversation with them? And what kind of conversation were you having?
Yeah. So, I mean, the biggest thing is it really starts with adding value in some way to other people, right? And so, Nathan, you and I really kind of connected through the Builders of Authority group on Facebook, right? And so like this idea of, if you're going and being an investor, the number one thing that you have to learn and realize is that you have a personal brand, right? And so a huge element of going and raising capital is going to be, what is the value of that personal brand that you have? And this is something I didn't know and understand at the time, years ago when I did it, but now that I'm in Adam's group and I'm in his paid mastermind, is, understanding that even further, right? And, so really what it was, again, whether it started on Bigger Pockets, I got investors through Bigger Pockets that I had never met before. It was just because I was active on those forums, adding value, answering questions, being transparent about my experiences, telling my stories, I was able to connect with some folks, have those dialogues, and build that connection with them. With others, it was, people that we knew in our networks. I mean, my business partner, again, he went to business school. He works in, high finance. And so he has connections with other folks that are in there. And so, he knew people who had money, they had done other investments. And so we were able to go and approach them about, hey, here's what we've got going on. But again, why were we able to do that? Because we had been giving value in other ways to be able to raise our own personal capital, not financial capital, right? But like the value of what it would mean to work with me and my integrity and the relationship I have with you and that sort of stuff. And that was really like the biggest thing to being able to approach folks, is adding a lot of value first. So like you said, like it probably, like from the time that I started looking at properties. And I didn't know when I first started looking if I was going to be flipping or doing buy and hold or whatever it was. That was more so like I wanted to do a deal, and however that penciled out, that was going to be my way in, right? So I wasn't closed to one specific thing. I also started looking in New Jersey near where I lived, and then ultimately ended up going to Wilmington, which is where that first property happened to be. So like it was a very fluid process that probably took me like a year and a half to 2 years between when I started deciding I was going to be a real estate investor to where I was at that point writing that prospectus and raising the capital, right? So this wasn't something that happened overnight. It was like I was going to the RIA meetings, like you talked about, the ones you've presented and talked to and stuff like that. I was getting to know those people. I was learning from them. I was asking them questions, figuring out how I could add value. And, even just being grateful when they would provide feedback to me. I remember having written that prospectus and sending it to other more experienced investors that either were private lenders or who I knew raised money from private lenders. And I would ask them for feedback to say like, hey, if somebody sent you something like this, what are some additional questions that you might have or whatever it would be? And whether you're buying that person lunch to go over that with them or whatever it might be, you're like anything else, you're going to make 100 offers in real estate to get one accepted, right? Like there are people out there in the real estate world who will sit down with you and give you feedback. You might have to be told no 50 times before you find somebody who will say yes to you. But if you can't get comfortable with getting told no, then real estate's not going to be a place that you're going to really long-term be able to play in. But so again, I think that's a lot of it, to be honest with you.
So if you were going to make, you're not right now, but if you were going to make a pitch to raise private money to an investor today, knowing what you know, being who you are, what would that pitch look and sound like? What offer would you be making to them so that they might be interested in doing business with you?
Yeah. So there's probably two different, ways that you would go about pitching somebody, right? So one is there's a whole host of people who are familiar with this real estate space, right? So a lot of real estate investors also have their self-directed IRAs. And so they loan money out, in that way. So like if you're in those RIA groups and you're in those different, real estate circles and you're trying to approach somebody who is more experienced and is now leveraging their returns from their self-directed IRA into investing other people. Again, that's really where they know how to look at deals and underwrite deals. They're, again, especially if they're in your market, they're going to know the areas that are good, that are bad, what to look at, what to look for. They're probably even going to know the contractor, like they're going to have the information. So it becomes, again, a lot more about that story of character more than it is anything else. And so what I would be doing with those folks is, the odds of you going to them cold with a pitch that says, hey, this is what, I want to, here's what I'm going to go do. And here's the money that I need. You're not going to have an easy time doing that if you haven't already built a relationship with that person. So how would I go about doing that? I would first invest the time to build the relationship so that when the deal is there, I feel a lot more comfortable talking to that person, especially if I've already been talking to them about deals that aren't penciling out, right? And so they know that I'm doing my due diligence and saying no to lots of stuff so that when I come to them with a deal that I think is going to work, they know that I understand the difference between a deal that does and doesn't work. The flip side to that would be is if you're going to somebody who already knows your character, right? These are usually like the friends, family, acquaintances, former bosses, colleagues, whatever kind of a thing. So they know you and they're comfortable with you, but they may not understand this idea of investing in real estate as a private lender and what goes there. So from that perspective, it becomes a lot more about that education of, hey, this is a normal thing that people do. Let me share some resources with you. And so it would be going and finding testimonials about, that you can find, I'm sure, lots of them now on YouTube or in other places of people that like, hey, here's how this process works, right? And so that they're hearing it not just from you, but from other people on channels that have tens of thousands or hundreds of thousands of followers. I don't know them, but I'm sure they exist out there. And so being able to build up kind of like hey, this is a thing, here's how it works, it's fully legal, like here's what that process will look like, and being able to walk them through it. Here's the kind of returns that you could expect compared to what the stock market's been doing or whatever else you might be having. If you don't have this money in a self-directed IRA, let me explain to you what that is. Here's some examples of custodians that you could transfer money into to do this sort of a thing. And you basically need to like build out your knowledge of how that, as you kind of point out, the logistics of lending to you would work, as well as explaining to them how they're protected, right? Hey, we're going to sign a mortgage and a note. This is going to be recorded, and no different than your bank could foreclose on your primary residence. You know, if you stop paying, if I can't pay you back, you can foreclose on me. And if you feel really comfortable and confident with yourself, I would strongly encourage you as an investor to even be able to sign over a deed in lieu of foreclosure as part of your initial documents, which basically puts into writing that that person can bypass the foreclosure process because you're already giving them the right to take possession of the property. And so by putting that in front of them, that's an additional risk mitigator to them that, yeah, you really need to step up and deliver and make sure you've got all those extra levers, you know, that you've done your own contingency planning for where am I going to get the money to take care of this investor. And if you're not willing to put yourself further into debt or bankrupt yourself, you know, in order to save one of your investors, then you really need to question what you're doing in real estate, because you need to take care of them before you take care of yourself, because it will come back to bite you in the ass. Because if you ever decide to get back into real estate, like it will come back to you because people are going to ask questions and things are going to happen. Versus when you can tell those stories of how I saved that investor, that's when you're going to be able to, again, go and raise money, because that's what people are going to appreciate. So I think like those are the two things that, like, you know, I think of like private investors coming from kind of two different buckets and how I would approach those two scenarios differently.
And then what type of offer, like as far as like terms of the loan, how would you structure that?
Yeah. So when we've done it in the past, what we've kind of always done with folks is we offer them a 1%. And again, my math may be off. I'm not up to date right now. Like I said, it's been a couple of years since I've bought a deal. So I'll tell you what terms we were offering pre-COVID. And you may just need to adjust all of these numbers, you know, for a post-COVID environment. But we were offering a 1%, you know, at loan closing. So basically they would just hold back 1% of the mortgage amount or the note amount when they funded the deal. And a lot of times that was because like when somebody has funds in their self-directed IRA, that person has transaction costs. So every time they have to move money, they have to pay fees. And so we would give them that 1% right at funding the loan, so that basically they weren't having to come out of their pocket or dip into their retirement account to pay those fees. They were getting that upfront. Then we would pay them the interest rate, and we were typically paying about 9 or 10%, depending on what the person was looking for. And then we would basically offer them two options. So, hey, do you want us to make payments, you know, and then you get a regular reoccurring monthly payment, or do you want to let the interest compound and then we'll pay you when we refinance it? One of the things that we did, because the credit union that we happen to utilize did not have any seasoning periods. So we actually had a couple of times where like we were able to get in, get the work done, get out in less than 6 months. And so some of the investors were like, hey, if I'm lending out this money, I want to make sure I at least get a minimum return, because even if I'm getting the money back in 6 months, there's still a risk associated with me putting all this money out. So at some point, we actually started offering them a guarantee of 6 months interest. I think it was 6 months. It might have been 3 months. So basically we said like, hey, if we pay you off sooner, you're still going to get a minimum of this amount of payment, regardless of what happens. And then if it goes longer than that, that's when like the compounding and all of that will start taking into effect. And then we did all of our notes as 12-month notes. And so we had one scenario, like I said, where we got to 12 months, we had to pay the person off. We had another time we got to 12 months and the person decided to extend, right? So I mean, it doesn't lock you in, but you want to have those conversations. You want to talk through, again, what terms make sense. And depending on where the money is and what they do with things, where things go. So that was, I call it a very, very high level, you know, kind of how we structured, you know, rates and terms and stuff along those lines. And they always had first position on the loan. That was the other piece. So, you know, they were always in that position of first refusal. Trying to think what else we had all in there, but we tried to make it as favorable to the lender as we possibly could, because they knew that we needed to obviously have terms that were favorable enough to make the deal work. So, you know, there was that side of it. You know, they were getting slightly better than market returns, and it diversified their risks, or their portfolio allocation was what a lot of them were interested in. So,
yeah. And I've not raised private money, so this is a fascinating conversation to me, but I heard that you can offer things like renewal fees to your investors to say, if I can't refinance this within 12 months and get this whole thing done, which is unlikely, I'll pay you a renewal fee X to X dollars or X percent of the loan or whatever. And so that often can help you if you're stuck, if you're thinking through how to do this like I am, then you probably can put that into your perspective, how you're going to deal with it.
Yeah. I mean, like I say, one of the cool things about all this stuff with private money is like there is some quote unquote normal type stuff, but there's also like opportunity to get as creative as you want in terms of like what your specific business model is or what your investors are looking for. So sometimes that's kind of the cool stuff when you deal with investors who don't do this all the time. They're going to come up with their own creative terms that you might go, hey, that's actually a really good idea, you know, and as an investor, I see where that benefits you and it doesn't change the deal materially for me. So when you can offer terms like that, or, you know, you just need to understand where it's all going to come from. But, you know, at the end of the day,
they're not a bank, so you can make adjustments.
Yeah. Yeah.
Love it. I love it. All right, James, I know you also have an accounting business. We didn't get too far into that. We're coming up on an hour. Yeah. Tell us a little bit about the bookkeeping service that you provide for contractors and how you put profit first within their business.
Yeah. So one of the transitions I had coming out of my corporate career was I loved coaching and mentoring a whole lot. And so whether that was new investors coming into the space and teaching them how to, you know, to do the investing. It's actually, I had a former coworker, you know, who invests in Indianapolis, and he's from New Jersey. So he did exactly what you talked about. He connected with some folks in Indy. He went out there, went to some RIA meetups, met up with some people, kind of did all that stuff, and then started buying property out in Indy, right? And so it's like, you know, that's a very true viable strategy. If you're in like a higher cost of living area where the properties aren't there, you can go to a market like St. Louis, totally take advantage of the offer that Nathan had, and like that's a great viable way to be able to get into the real estate game. But I loved doing stuff like that, providing the knowledge that I had to other folks. Again, mentoring my employees on, you know, how to grow in their careers. And as an investor in real estate, I specifically saw, again, there's a book, The E-Myth Revisited, if folks haven't read, where they talk about this idea of working in your business and not on your business. And I saw a lot of those contractors that, you know, they got into the business because of whatever reasons. They may have been skilled craftsmen, but they did not know how to run a business or to grow and scale a business. They knew how to sell, they knew how to do the work, but they didn't understand the rest of it. And so for me, it was really kind of the combination of those passions of going, hey, there's a whole bunch of folks out there who kind of, you know, they again, 50% of businesses don't make it 5 years, and 80% of those fail because of cash flow issues. And specifically in the contractor space, it's oftentimes because people don't know how to price their work, because they forget the fact that they are doing the work themselves. And so they don't price that stuff in. They forget that they have to buy tools and things like that. They forget that they have to hire people and they have to grow. And so they don't put enough margin into the work that they're quoting to ever be able to, you know, really grow what they need to grow. So that was a lot of the reason why, like, as I was looking kind of like for what's next, the idea of acquiring an accounting firm, even though I'm not an accountant, was all about being able to help people in that way. And I was familiar with Profit First. And so to me, that was the bridging tool that was like, okay, this is where I'm going to be able to leverage kind of the financial knowledge and information compounded with my operations background to be able to help people understand their numbers and how they can then use that to put in the systems and processes and technology to allow them to scale. So that's kind of, again, we, on the actual accounting side of things, as I kind of said, we do everything except for taxes and collections. You know, my team's capable. We're a silver partner with Gusto on the payroll side of stuff. I've got a fully remote team of 5 other folks. You know, I've got team leads and then bookkeepers. So we can kind of cover the full gamut of things. And then right now I'm the one doing all the Profit First coaching and kind of like, if you want like higher level, you know, cash flow stuff and you know, projections and forecasting and stuff like that. I did a lot of forecasting in my supply chain world. You know, that, like, call it CFO services. That's really where I step in to help businesses. But we also have a really cool, there's a platform out there called School, which is SKOOL. So we've also recently launched both a free school community for folks who are interested in kind of wanting to self-implement Profit First, or are interested in just kind of learning a little bit more about what that is, and being able to if you just kind of like need that accountability aspect of things, right? That's where you can go for that. But then we also have a paid community on school, which is kind of a middle step. So if you're somebody, there's a lot of businesses that are, especially on that smaller end of things, if you're in the like 2 to 300,000 K in revenue range, where like you need that help and support and guidance, but you don't have enough revenue to like pay for those full-time services. And so that's more of like a group coaching program where I'm there once a week. My team leads are there once a week. And so, we can go through like profit first or other business related questions you have about technology or HR or marketing or whatever it is. And then my team is there another day of the week that if you're going through your bookkeeping, your QuickBooks or whatever, because you can't afford to hire somebody, but you have questions about how to do things, we're there to help support people. So we're really trying to have solutions that help everybody from, hey, I'm just getting started and wanting to learn, through the stage of, I still need to do it myself, but I have a little bit of money to ask for help. And how do I get that? To, hey, I'm a more established business. I want the professionals to take care of things. And then I need to bring on that expert advisor that's going to help me take my business to the next level.
Yeah, I love that. And so how can people get in contact with you, James, if they want to be a part of the school platform, if they want to get more information, or heck, maybe they need accounting services?
Yeah, so our website is ourteamaccounting.com. So you can see it right here on my shirt, Our Team Accounting, sorry, it's all backwards. So ourteamaccounting.com. There you go. You got it right there. And then if you just do / Profit First School, again, that's SKOOL, that'll take you right over to the free school community. And then if you were interested in the premium community, once you get into the free community, in there, you'll be able to just send me a message and you can basically ask and I can get you steered over into that. But obviously if you land on our website, on there, you can learn all about our team and how we do our work. And then from there, you can book a call. And if you want, the full accounting or coaching services.
Awesome. Thanks, James, so much for being a part of our program today. I'm sure that this has been enlightening and eye-opening and engaging for so many people.
Yeah, I hope so. Not quite. I don't know if I quite hit Tony Stark level. I mean, I tried to bring the heat, but
yeah. Well, I mean, you figured it out. So that's the big thing. And hopefully we can leave the legacy for everybody else on how to do this so that they don't have to be as scared of real estate investing. Yeah. So thank you so much for taking the time to do that. And remember, if you want James's prospectus, comment prospectus in the comments, and we'll make sure that we reach out to you and see if we can get that to you. All right. Thanks, James.
Absolutely. Thanks, Nathan.
All right, guys. So there you heard it. You heard it from James Masotti. He's just incredible, isn't he? I mean, this is the guy that owns the bookkeeping business that's looking at profit first for your business and is telling you exactly step by step how he specifically was able to do private money on his real estate transactions. I mean, I can't do it any more direct than this and be able to offer you the prospectus. Like, guys, that's just the coolest thing that I've found in my business. Remember, we all have a circle of knowledge. I was talking about this last night with a group of real estate investors. We have this circle of knowledge, right? So think about your first experience with money in your lifetime. My first experience, I've told this story before, but I don't know if I've told it on the podcast here. So my first experience with money, my grandmother and grandfather actually gave me for Christmas one year a tree with these little tubular things and ribbon tied around them. And when I opened each one of the different pieces of ribbon, I found out there was a $1 bill and a $5 bill and a $100 bill. And it really helped me to frame my whole entire thought process of money as I was growing up, because the connotation there, the joke was money doesn't grow on trees. I'm sure you're very similar, that you grew up where you heard the comment, a penny saved is a penny earned. The truth is it's a penny. Like, we have these concepts of money that we grow up. If you drew a circle on the screen right now, and I put a pie graph on there, there's a certain amount of knowledge about money that that's the pie graph. And then there's a certain amount of things that you don't know. There's also this whole little sliver of things that come through that pie graph of things that you thought to be true that turned out not to be true. And private money is one of those things. You've maybe heard about it, or maybe heard horror stories, or don't even understand it, and so you've shied away from it. That's why I put this program together for you. It's to help redefine and help you re-experience money from a different perspective. And we will be forever grateful for James for laying that foundation. And that, Renovation Nation, that brings us to the end of another episode. I'm Nathan Bush. I'm your guide on this real estate journey of business growth. And remember, just like plants need the right air, soil, and care, our minds need the right environment to build a life of purpose, passion, and growth. And don't forget to get your citizenship to Mind Renovation Nation. You got to subscribe to the YouTube channel, join my email list at nathanbushmba.com/subscribe, and then share the show. Because when you share the show, that lets other people know that we're available every Friday at noon for their real estate and mind workout. That's what we're doing each and every week. So join me next time for more insights, inspiration, of course, a little bit of that nation-building spirit that drives us to create a community of shared values by purpose and commitment to leaving a lasting legacy. Until then, I want you to keep building, keep growing, and let's lead more than 25,000 souls to a life of values-based investing. In our journey of Mind Renovation Nation, we often talk about personal growth, ethical leadership, and making impactful choices. Values-based investing is an extension of that philosophy. It's not just being a steward of our finances, guys. It's about being a steward of our values and vision for the future. And you heard firsthand from James Msadi today that you got to lead with your personal values. You'll never be bigger on the outside than you are on the inside. People see those values, and that's what they invest in. Signing off from the heart of St. Louis, stay blessed, stay inspired, and remember, every day is a chance to build your nation. Till next time, guys.